Imagine you're looking at options on, say, your favorite tech stock. It's trading right around $100 a share.
Okay.
You see a call option, strike price $100, expires in 30 days. And then you see a put option, strike price $95, same stock, also expiring in 30 days.
Got it. Same underlying, same expiration, different strikes.
Now, if you took those two options, plugged them into a standard, classic option pricing model, maybe Black-Scholes.
The foundational one.
Yeah. And you keep everything else the same underlying price, time, rates. You'd sort of expect something consistent about what the market thinks about future price moves, wouldn't you?
Logically, yes. You'd think the model should spit out the same implied volatility, that measure of expected future choppiness for both options.
That's the neat, tidy picture those models paint, right? Based on assumptions like constant volatility and prices moving in that nice, predictable log normal way.
Exactly. In that perfect theoretical world, implied volatility would just be one single number, constant across all the strikes for that expiration. The market's unified view, if you like.
But then you step away from the textbook, look at a real trading screen, and that perfectly flat line of implied vol disappear.
Poof, gone. Not what you see at all.
The actual market prices of that $100 call, that $95 put, and all the other strikes, they tell a completely different story.
They really do. Their prices actually imply different levels of expected volatility, and it specifically depends on where that strike price is sitting relative to the current stock price.
And we're not talking small differences here. It's a fundamental, observable market reality that really shapes how options get priced, how people hedge, what kind of risk premium is baked into different contracts.
And that departure from the simple model, that observed reality, that's what we call the volatility smile and the volatility skew, is absolutely critical stuff for anyone trading options, managing risk, or honestly, just anyone wanting a deeper insight into market expectations beyond the headlines.
Yeah, absolutely. And for this deep dive, we've pulled together quite a bit. We've got explanations from seasoned options traders, people who deal with this daily.
Right, the practitioners.
We've got insights from the quants, the financial engineers trying to model this stuff.
The model builders trying to make sense of it mathematically.
And even a peek into what's taught in advanced university courses on option pricing. So a good mix of perspectives.
That sounds like a solid foundation. So our mission today is really to unpack these concepts, right?
Exactly. Understand not just what they are, but the why. Why do they even exist?
And how they look different in stocks versus currencies versus commodities. Because they do.
Big time. And then what does it all mean practically? For valuing options, for how those Greeks behave, for designing trading strategies in the real world?
Yeah, we want to go beyond the sort of option pricing 101 and get into some of the more sophisticated aspects, really give you a clearer, more complete picture of this whole volatility landscape.
Okay, let's do it. Let's really dig in by starting with that fundamental building block, implied volatility of 4. We hear it all the time, but let's just ground ourselves in what it means here.
Absolutely. Good place to start. Implied volatility. It's essentially the market's collective forecast. It's expectation of how much the underlying asset, stock, index, currency, whatever, is going to move.
Between now and when the option expires.
Precisely. And crucially, it's not historical volatility. Historical volatility tells you how much it did move in the past.
Right, looking backward.
IV is looking forward. It's what the market thinks will happen.
And we figure out this IV number by looking at the options price right now, the one trading in the market.
Exactly right. You take the current market price of an option, you plug it into your pricing model, like Black-Scholes.
Even though we know it has limitations.
Right. Even knowing its limitations, it's the starting point. You plug in the option price, the current stock price, the strike, the time left, interest rates, any dividends.
Yeah.
All the known stuff.
Okay.
The only thing you don't know directly is that future volatility. So you work backwards. You ask the model, what volatility number do I need to assume to make your theoretical price match the actual market price?
Okay. So the IV is just the plug number, the value the model needs to justify the observed market price.
That's it. It's the implied part. And, as some of our sources like Chicago Trading Co. point out, in those standard models, IV is often the only parameter you can really tweak like that. Everything else is pretty much fixed or directly observable.
Gotcha. And this brings us back to those model assumptions you mentioned earlier, the ones Black-Scholes makes that are relevant here.
Yeah, 2 big ones for this discussion. First, it assumes the volatility of the underlying asset is constant, stays the same over the whole life of the option.
Which we already know isn't quite true in reality.
Definitely not. And second, critically, it assumes the underlying asset's price follows a log normal distribution.
Log normal distribution. Okay, help us picture that again.
Think of the classic bell curve, the normal distribution. Log normal basically means the percentage changes in the price follow that bell curve shape.
So small percentage moves are common, big percentage moves are rare, and it's all nice and symmetrical.
Exactly. Movements around the average are most likely, and extreme moves way out on the tails of the curve get increasingly unlikely in a very specific, predictable pattern. Smooth, symmetric outcomes.
Okay, so if those assumptions were perfectly true, constant volid, perfect log normal price changes, what would the implied volatility look like if we plotted it across different strike prices for options expiring on the same day?
If that theoretical world was reality, then yes, the implied volatility you'd calculate from the market prices would be the exact same number for every single strike price. Doesn't matter if it's way out of the money or right at the money.
So on a graph of IV versus strike price, it would just be a flat line.
A perfectly flat horizontal line. That single IV number would represent the market's unified expectation of volatility for that time period. Investopedia, Chicago Trading Co., they all confirm this theoretical baseline. The CBOE even talks about the average level of the curve reflecting the average expectation.
But here's the kicker. That flat line is almost never what you actually see.
Almost never. In the real, live market, implied volatility is absolutely decisively not constant across strikes for the same expiration. And that gap, that difference between the flat theory and the curvy reality, that's the volatility smile and skew.
So these terms smile and skew, they're just names for the shape we see when we plot implied volatility against strike price.
That's exactly it. Instead of the flat line, you get a curve. Sometimes it looks like a smile, sometimes it's tilted or skewed.
And the shape itself tells a story.
It does. And it's worth noting, as a few sources mention, the terminology can be a bit loose sometimes. People might use smile or skew interchangeably, or for slightly different curve shapes we'll get into. But the core concept is 4V changes with the strike price.
And this change isn't random noise. The shape of that curve is often quite distinct and consistent within specific markets, right? But different between markets. It's fascinating.
It really is. The characteristic shape tells you a lot about the perceived risks in that particular asset class.
Okay, let's start with the one most people watching might know best. Equity markets. Individual stocks, big indices like the S&P 500, what shape do we usually see there?
In equities, the classic shape is a downward sloping curve.
Yeah.
It's usually called the volatility skew, or sometimes, a bit more graphically, a smirk.
A smirk. Okay, so what does that look like on the plot?
Imagine plotting strike price on the horizontal axis, low to high, and IV on the vertical. For equities, as you move from the high strikes, the out-of-the-money calls, down towards the low strikes,
right,
the out-of-the-money puts, the implied volatility generally increases.
So the puts, the options below the current price, have higher IVs than the options right at the money.
Correct.
And the calls, the options above the current price, tend to have lower IVs than the at-the-money ones.
That's the typical pattern. It creates that downward slope from left to right on the graph. Low strikes have high IV, high strikes have low FOB.
Got it. That's the equity skew or smirk. Sources like Investopedia, Wikipedia, Tasty Live all point this out.
Yes, it's the dominant pattern there.
But then you look at, say, currency markets, foreign exchange, FX. The shape is different.
Often, yes. In FX markets, you frequently see something more symmetric, more convex. This is the classic volatility smile.
A smile. Okay. How's that different from the smirk?
Instead of just the puts having higher 5E, both the OTM calls and the OTM puts tend to have higher implied volatility than the options right at the money.
So the lowest point on the IV curve is near the middle, near the current price.
Exactly. And the curve rises on both sides as you go further out of the money, up or down. Forms that U-shape or valley or smile. You can see charts showing this, like for USD JPY in the Chicago Trading Co. materials.
So with a smile, the market seems to be pricing in a higher chance of big moves in either direction, up or down, compared to smaller moves?
That's the interpretation. It's pricing those wings or tails more highly, symmetrically. Contrast that with the equity skew, where the market seems much more concerned about the downside wing.
And then there are commodities. They have their own personality, too.
They often do. Things like soybeans, coffee, sugar, orange juice examples mentioned in the sources frequently show an upward sloping curve.
Upward sloping, so the opposite of equities.
Kind of, yeah. This is sometimes called a positive skew or maybe a demand skew. Here, it's the OTM calls the options betting on prices going much higher that tend to have significantly higher implied volatility than the ATM options and often higher than the OTM puts.
So the curve slopes up from left to right, Low strikes have lower IV, high strikes have higher 5.
That's the shape. Higher 5 for the upside potential.
Wow. Okay, so we've got the typical negative equity skew sloping down, the FX smile like a U shape, and the commodity positive skew sloping up. 3 really different shapes.
Reflecting very different underlying market dynamics and risk perceptions. Recognizing the typical shape for a market is really the first step.
Which leads us right to the big question. Why? If the basic model says IV should be flat, what's going on in the real world to create these curves? Our sources seem to offer a few different but related explanations.
They do, and it's important to see how they fit together. One of the most direct angles, especially from the perspective of traders on the ground, comes down to basic supply and demand, driven by what market participants expect and how they behave.
Okay, walk us through that supply and demand picture, especially for that common equity skew. Why are the puts usually higher IV?
Well, think about who's in the equity market. You have a huge number of investors, institutions, even individuals who are fundamentally long stock. They own shares.
Right. Their biggest risk is the market falling.
Exactly. So there's a natural, persistent demand for protection against downside moves. Portfolio insurance. And how do you buy insurance against falling prices?
You buy put options, especially out-of-the-money puts.
Precisely. This ongoing structural demand for OTM pushes their prices up relative to where a simple model might say they should be.
Okay, demand for puts raises their price. What about the calls?
On the call side, you might have people selling OTM calls, maybe against stock they already own covered calls, to generate some extra income.
Right, yield enhancement.
Or perhaps there's just less perceived urgency or structural need to buy far OTM calls compared to the persistent fear driving put buying. I mean, people want upside, sure, but the fear of losing a lot quickly often outweighs the hope of gaining a lot quickly, especially for hedgers.
So high demand for OTM puts, maybe more supply or less intense demand for OTM calls relative to the ATM options.
That's the dynamic. This supply-demand imbalance directly translates into higher prices for the OTM puts and relatively lower prices for the OTM calls. And when you take those market prices and backsolve for implied volatility.
The puts give you a higher IV number and the calls give you a lower IV number. Bingo, the negative skew.
Exactly. Sources like Chicago Trading Co., Investopedia, Tasty Live all really emphasize this supply-demand angle driven by hedging needs.
And it feels like past events like big crashes play a role in keeping that fear alive.
Oh, absolutely. The market has a long memory, or at least market structure reflects past traumas. The empirical fact is stocks tend to fall faster and harder than they rise. Up the stairs, down the elevator, as they say.
Like 1987.
The classic example. That crash wasn't gradual. And Wikipedia points out that the equity skew we see today became much more pronounced after '87. That event really hammered home the potential for sudden, huge drops, reinforcing that demand for put protection. It's partly a fear premium priced in.
So the market isn't just pricing average future movement, it's specifically pricing the risk of those nasty downside surprises.
Yes, it's pricing the tails differently. And this S&D logic applies elsewhere too. Commodities. The big fear might be a sudden price spike, drought, supply disruption, whatever.
So demand for OTM calls goes up.
Right. Hedgers need protection against soaring prices. Speculators bet on it. That drives up OTM call 5e, giving you the positive skew. FX. Maybe risks are seen as more balanced, big moves possible either way due to economic shifts or central bank actions.
Leading to demand for both OTM puts and calls, hence the smile.
Exactly. So that's the trader's view, focused on market behavior. What about the quants, the financial engineers? How do they see it?
They seem to frame it more as a limitation of the models themselves.
That's right. From a quantitative finance perspective, the smile or skew exists partly because the standard models, like Black-Scholes, are just too simple. Remember that key assumption. Log normal distribution of future prices.
That nice symmetric bell curve for returns.
But when you actually look at historical returns for real assets, stocks, currencies, whatever, they don't usually fit that log normal picture perfectly. They deviate.
How so? What are the main deviations?
Two big ones. Fat tails and skewness.
Fat tails, meaning?
Meaning extreme events, really big up moves and really big down moves, the stuff way out on the edges or tails of the distribution, happen more often in the real world than a pure log normal distribution predicts.
The model underestimates the chance of big surprises.
Exactly. This is also called high kurtosis. The real world has more jump risk than the smooth model assumes.
Okay, that's fat tails. And skewness.
Skewness means the distribution isn't symmetric, it's lopsided. For equity returns, like we just discussed with crashes, the distribution tends to have a negative skew.
meaning big downward moves are more likely or happen more often than equally big upward moves.
Precisely. The left tail, the downside, is fatter or heavier than the right tail, the upside.
Ah, okay. So the market prices options based on these real-world odds, higher chance of any big move, fat tails, and for equities, a higher chance specifically of big down moves.
Negative skewness.
You got it. Now, the Black Scholes model is built on that thin-tailed, symmetric log normal assumption. It uses just one volatility number to represent the width of that theoretical curve.
But the market prices reflect a different reality, a wider-tailed, maybe lopsided distribution.
Right. So to make the model's price match the actual market price, that single volatility input in the model has to be different for options that are sensitive to different parts of the probability distribution.
Okay, so options way out of the money, both puts and calls, are sensitive to those tails. If the real tails are fatter than the model assumes,
then those OTM options will trade at higher prices than the model would predict using just one average volatility number. And to make the model match that higher market price, you have to feed it a higher implied volatility specifically for those OTM options.
exactly. That explains the smile-shape higher IVs for both OTM calls and OTM puts compared to the ATM options. It's the model adjusting for kurtosis for those fat tails.
And what about the skewness part, the lopsidedness in equities?
If the real distribution also has negative skew, the left downside tail is even fatter than the right upside tail, then the OTM puts, which are sensitive to that fatter left tail, will be priced even higher relative to the OTM calls, which are sensitive to the right tail.
So that difference in pricing translates into the OTM puts having even higher IVs than the OTM calls.
Precisely. And that creates the tilt or the skew within the overall smile shape, higher 5Es on the put side than the call side.
So the smile and skew are kind of like the market using IV as a correction mechanism, telling the simple model, hey, your assumed distribution is wrong, the tails are fatter, and for stocks it's tilted downwards.
That's a really good way to think about it. The implied volatility curve we see is basically the market's way of mapping its perception of the actual underlying probability distribution, including its fat tails and skewness, onto the single volatility input of a simplified model. The Chicago Trading Code charts comparing these distributions are quite helpful.
Okay, so we have market dynamics, supply and demand for hedging, and we have model limitations. Real-world distributions aren't log normal. Is there a third perspective, maybe from risk managers?
Yes, definitely. From a risk manager's standpoint, the reason why the smile or skew exists is interesting, but the crucial fact is that it does exist. It's real. It affects portfolio values, the mark-to-market, every day.
Right. It's not just theory. It has real dollar consequences.
Absolutely. If you're managing a book of options, the value of your positions changes not just when the underlying stock moves, but also when the implied volatility of each option changes. And how that IV changes depends on its strike price and where it sits on that curve.
So you can't just use one volatility number for your whole portfolio when you're figuring out your risk or your hedges.
No way. If you're trying to calculate your overall exposure, like your delta, or trying to delta hedge dynamically, you have to account for the fact that IV is different at different strikes. If you ignore the skew, your risk calculations will be off.
Especially if the underlying makes a big move.
Exactly. A big move pushes options further into or out of the money, sliding them along that volatility curve. If you haven't accounted for how their high V will change as they slide, your hedge might not perform as expected. This practical need to manage risk accurately is a huge driver behind formally modeling the skew.
Which leads us perfectly into how traders and quants actually try to handle this reality. Since the skew is there and it matters, you need ways to describe it, maybe predict its changes, and build it into your calculations.
Absolutely. And a key challenge is figuring out how the whole curve, the smile or skew shape for a given expiration date, behaves when the underlying stock price itself moves. This brings in ideas like sticky strike versus sticky delta.
Right, I've heard those terms. They sound like different assumptions about how the curve reacts.
They are. They're different hypotheses or models for how the implied volatility surface shifts when the underlying price changes. Sticky strike is the idea that if the stock price moves, the implied volatility associated with the specific absolute strike price stays the same.
Okay, so give me an example. Stock's at $100. The $90 strike put has an IV of 25%. Stop drops to $95. Under sticky strike.
Under sticky strike, that $90 strike put, which is now closer to the money, would still have an IV of 25%. The volatility value is sticky to the $90 strike price itself.
Got it. The IV stays with the strike number. What about sticky delta?
Sticky delta, or sometimes sticky moneyness, is the alternative idea. It suggests that if the underlying price moves, the implied volatility associated with the specific relative moneyness level, often measured by the options delta, stays constant.
Okay, back to the example. Stock at $100. The at-the-money option, maybe delta 50, has an IV of 20%. Stock drops to $95 under sticky delta.
Under sticky delta, the new at-the-money option, which is now the $95 strike, would inherit that 20% IV. The previous ATM option, the $100 strike, is now OPM, and its IV would change to whatever the IV normally is for options with its new lower delta.
Ah, so that IV is sticky to its relative position, like being ATM or being 25 delta OTM, not the absolute strike number. The whole profile shifts with the stock price.
Exactly. Under sticky strike, the profile stays put relative to the strikes. Under sticky delta, the profile moves with the underlying. Reality is probably somewhere in between, and it can vary by market or even over time. But understanding these different dynamics is crucial for things like dynamic hedging.
And actually modeling the skew formally means trying to describe its shape mathematically, doesn't it?
Yes. Quants use specific mathematical models designed to capture the smile or skew and how it behaves. The Reddit source in the university syllabus mentioned models like CBR or Heston. Stands for stochastic alpha, beta, rho. It's a popular one for fitting the volatility smile. It uses a few parameters, alpha, beta, rho, nu, to describe the curve. Alpha basically sets the overall height or level of volatility.
Okay.
Beta relates to how volatility changes with the forward price. Rho controls the skew or the tilt of the curve. And nu, often called the vol of vol, controls the curvature or the smile, how U-shaped it is.
So these parameters give traders a shorthand way to talk about the shape, like the rho is steep or nu is high.
Exactly. It allows them to quantify the shape and model how it might evolve. Because it's not just about the shape right now, it's about understanding how that shape might change as time passes or as the underlying price moves. That's key.
Right. How does the IV of my specific option change if the stock goes up or down or just as we get closer to expiry?
Precisely. That links back to those sticky strike at delta ideas and also brings in other sensitivities.
Okay, so we've got volatility varying by strike. That's the smile or skew. We've talked about how that curve might shift as the underlying moves sticky strike versus sticky delta. But there's another big dimension, isn't there? Time.
Absolute critical. Implied volatility doesn't just vary by strike price. It also varies depending on how much time is left until the auction expires.
So just like we plot 5 against strike for one expiration date, we can also plot OFI against the time to expiration for a particular strike, or maybe for all the at-the-money options.
Exactly. And that plot is known as the term structure of volatility, sometimes called the forward skew, because it shows the market's expectation of volatility over different future time periods.
And what does that term structure usually look like? Is there a typical shape?
Often, yes. The typical shape is upward sloping. Longer dated options generally have higher implied volatility than shorter dated options.
Why is that?
It makes intuitive sense, doesn't it? There's just more time for uncertainty, for unexpected things that happen between now and expiration, if expiration is a year away, compared to if it's only a week away. More time equals more potential for price swings, generally leading to higher expected volatility. Both Investopedia and Tasty Live mention this common upward slope.
But it's not always a smooth upward slope, especially at the front end, the near-term options.
That's right. This is where known scheduled events really make their mark. Think about a company's earnings announcement or a Fed interest rate decision, major economic data releases. For commodities, maybe a critical crop report.
These are dates on the calendar that everyone knows could cause a big price move.
Exactly. And because these events have a much bigger potential impact on options expiring very soon, right before or right after the event, they cause noticeable bumps or dips in the implied volatility for those specific near-term expirations. Wikipedia highlights this.
So you might see IV spike up for the options expiring the week of the earnings report, and then maybe drop back down for the options expiring the week after.
Precisely. The market is pricing in that expected burst of volatility around the event itself. This sensitivity of near-term vol to upcoming news is sometimes called the volatility of volatility.
Okay, so when you put it all together, the IV changing by strike, smile skew, and the IV changing by time to expiration term structure,
What do you get?
you get the full picture. The implied volatility surface.
The 3D map.
That's it. Imagine a 3D graph. Strike price on one axis, time to expiration on another, and implied volatility plotted vertically. It shows the market's IV expectation for every single available option contract on that underlying. Professional traders spend a lot of time looking at and interpreting these surfaces.
Okay, this is fascinating stuff. We've defined IV, we've seen the smile and skew shapes, we've explored why they exist from different angles and how they vary by market and across time. Now let's get really practical. How does all this directly mess with the tools traders use every day, the auction Greeks? Delta, gamma, theta, vega. Ah, yes. This is where it gets really crucial for pricing and hedging. Because the standard Greeks you calculate from a basic black skulls type model, they usually assume volatility is constant or changes in a very simple way.
But we know it's not constant. It changes with strike, it changes when the underlying moves because that shifts the option along the curve, and it changes with time because of the term structure.
Exactly. So those standard Greek calculations, they only tell you part of the story about how an options price will actually change in the real world.
So the delta number I get from my standard model might not accurately predict the real change in my options price if the stock moves $1.
It often won't be the whole story. Let's use that Chicago Trading Co. example again. It makes it really clear. Stock's at $100, you're looking at a $95 strike put.
Okay.
A simple model might say its standard delta is, let's say, -25, meaning for every $1 the stock goes up, the put price should drop by 25 cents. And let's say its current TIVE, based on the skew, is 26%.
Got it. Standard delta prediction, price drops 25 cents if stock goes to 101. What?
Right. But now factor in the skew. It's an equity, so it probably has a negative skew. As the stock price rises from $100 to $101, that $95 put becomes even further out of the money.
Okay.
And moving further OTM on a negative skew generally means its implied volatility will decrease. Let's say the IV drops from 26% down to 25% just from that $1 stock move.
Ah, so the IV itself changes because of the stock move and the skew shape.
Exactly. And that change in IV also affects the options price, right, through its vega.
Right. Vega is sensitivity to volatility changes.
So if this put has a vega of, say, 0.07, meaning its price changes by 7 cents for every 1% change in IV, that 1% drop in IV from 26% to 25% causes the puts price to drop by another 7 cents.
Whoa.
So the total change in the puts price when the stock went from $100 to $101 wasn't just the negative 25 cents from the standard delta. It was negative 25 cents from the price move plus negative 7 cents from the IV dropping due to the skew.
So the total price change was actually negative 32 cents.
Approximately, yes. So the effective delta, the real-world sensitivity to that $1 move, wasn't negative 25. It was closer to negative 32.
That's a pretty big difference. Nearly 30% more sensitive than the standard delta suggested.
It can be significant, absolutely. And that extra sensitivity comes directly from the interaction between the price move and the volatility skew. This effect is closely related to higher-order Greeks, particularly VANA.
VANA. What's that?
VANA measures how an option's delta changes when implied volatility changes, or, equivalently, how its vega changes when the underlying price changes. Understanding VANA is really about understanding how the option rolls around on that volatility surface as the underlying moves. It captures that skew effect on delta.
And this kind of adjustment applies to other Greeks too, like theta, the time decay.
Yes, it does. Standard theta just tells you how much value the option loses purely because time passes, assuming everything else stays put.
The ice cube melting.
Right. But as time passes, two things happen on the vol surface. One, the option moves closer to expiration, so moves down the term structure, potentially to a different IV level. And two, depending on how the underlying has moved, its relative moneyness might have changed, effectively shifting its position on the smile skew curve for that shorter time to expiration. Both of these can cause the option's implied volatility to change just due to time passing, adding another layer to the price decay beyond standard theta.
So there's like a skew theta or a term structure theta effect on top of the regular theta.
Exactly. Traders definitely think about these skew-adjusted Greeks. The Reddit discussions mention skew theta and skew gamma. To manage risk properly, you need models that understand the whole volatility surface and how it impacts these sensitivities.
You need models that give you those adjusted Greeks that reflect the real world, not just the simplified model world.
Precisely. A robust system needs to incorporate the volatility surface, the smile, the skew, the term structure, and assumptions about how it behaves, like sticky strike or delta, to give you a true picture of your position's risk.
Okay, this is starting to really connect the dots. So how do traders leverage this understanding in their actual strategies? What are the trading implications of knowing about the smile and skew?
Well, first off, just understanding the shape is crucial for reading market sentiment. A really steep negative equity skew. That screams fear, high demand for downside protection.
Maybe signaling anxiety about a potential drop.
Could be. A sudden steepening might mean that anxiety is increasing. Conversely, a very pronounced symmetric smile, say before a big Fed meeting, that might suggest the market expects a big move but isn't sure which way. High uncertainty.
So the shape itself is a sentiment indicator.
Absolutely. And it also helps traders spot potential relative value opportunities. If the skew on one stock looks way out of line with its historical pattern, or with related stocks, or with your own model, maybe there's a trade there.
Betting that the shape will revert to normal.
Or betting that the market is mispricing the relative risk between different strikes. And traders definitely design strategies specifically to profit from anticipated changes in the shape of the curve itself.
Okay, are there specific strategies for trading the skew or smile directly?
Oh yeah. To play the slope, or the tilt of the skew, a classic strategy is the risk reversal.
Risk reversal, how does that work?
Typically, you might buy an out-of-the-money call and simultaneously sell an out-of-the-money put, same expiration. Or you could do the opposite, sell the call and buy the put, often structured to be delta neutral at the start.
So you're betting on the difference in IV between the call and the put.
Exactly. In equities, the OTM put usually has higher IV than the OTM call. So if you buy the call, lower IV, and sell the put, higher 5E, you're essentially getting long the skew, betting maybe it will flatten, or profiting from the IB difference if it stays wide. You're trading the relationship between vols at different strikes. Wikipedia, Reddit sources mention this.
Okay, that's trading the slope. What about trading the curvature, the smile itself, like how pointy or flat it is?
Strategies like butterfly spreads are often used for that. A long butterfly, for instance, typically involves buying options at 2 different strikes and selling twice as many options at a strike in between. It can be structured to profit if volatility stays low, or if the implied volatility curve around the middle strike becomes less peaked, essentially betting against extreme convexity or vol-vol.
Trading the kinks in the curve, as one source put it.
Yeah, or the relationship between ATM vol and OTM vol. Straddles and strangles, buying or selling both a call and a put near the money, are often more about betting on the overall level of realized volatility versus the implied volatility, especially around that central part of the curve. Chicago Trading Co. talks about using these.
So you can get really specific, trading just the shape.
Absolutely. And this ties into the idea of owning skew versus selling skew.
Owning skew, what does that mean?
Generally, owning skew means having positions that benefit if the skew steepens or if there are large moves that benefit your OTM options. Typically involves being long OTM options.
Like buying those OTM puts in equities.
Exactly. Or maybe OTM calls in commodities. The downside is these OTM options usually have negative theta. They decay over time, costing you money if nothing happens.
The insurance premium bleeds away.
Right. But the potential payoff comes from positive gamma and positive vana. Your position gains value quickly if the underlying moves significantly in the right direction, especially if the IV of those options also increases due to the move, which often happens because of the skew dynamics.
Okay, so owning skew costs you theta but gives you explosive potential. What about selling skew?
That's the opposite. Selling OTM options may be covered calls, maybe selling naked puts or calls. If you have the risk tolerance, you're often selling that higher implied volatility out on the tail.
Collecting that premium.
Right. That can give you positive theta carry. You make money as time passes, assuming the underlying stays behaved. But the risk is significant. If there's a large, fast move against you, those OTM options you sold can suddenly become very expensive very quickly. Their IVs can spike, their deltas can explode. The Reddit source warns about this. Selling OTMs seems safe until it isn't. They can jump.
Okay, let's drill down on that tasty live example. The bear put spread in an equity market with negative skew, where there's also an active seller of puts. That seems to tie a lot together.
Yeah, it's a great practical illustration. So, scenario. You're bearish on stock, ABC, trading at $100. It has the usual negative equity skew, higher IV for the lower strike puts.
Okay.
You decide to put on a bear put spread. Maybe you buy the $100 strike put, which is at the money, and you sell the $90 strike put, which is out of the money, same expiration.
Standard bear put spread. Profits if the stock falls below 100, max profit below 90.
Right. Now think about the skew. Because it's a negative equity skew, that $90 OTM put you're selling actually has a higher implied volatility than the $100 ATM put you're buying.
Ah, right. Lower strike puts have higher IV in the equity skew. So I'm buying lower IV and selling higher IV within the spread structure itself.
Correct. You are structurally selling the higher vol leg and buying the lower vol leg relative to each other on the curve. Now, add the market flow element. Suppose there's a big player in the market who is aggressively selling the $100 strike puts. Maybe they have a different view or it's part of a larger strategy.
So there's extra supply pressure specifically on the put I want to buy.
Exactly. That selling pressure might push the offer price of the $100 put down a bit, maybe closer to the bid, potentially letting you buy it cheaper than the theoretical mid-market price.
So I can potentially get a better entry price on my long put leg because of this other seller's activity.
That's the idea. You're still selling the $90 put, which has the higher 5E, but you might get a discount on buying the $100 put. You typically put this on as a single spread order, specifying the net debit you're willing to pay.
So I'm using my bearish view combined with the structure of the skew, selling higher phi, buying lower phi, and the observed market flow, the active seller helping my entry price, to try and get into the spread at a better price.
Precisely. You're leveraging multiple factors. Your maximum gain is still limited, the difference in strikes minus your net cost. And your maximum loss is limited, your net cost. But by being aware of the skew and the order flow, you might improve the risk-reward profile of that bearish trade by lowering your initial cost.
That really shows how these concepts aren't just academic. They directly influence how traders might execute even relatively standard strategies. But we need to remember that caveat, right? High five or steep skew doesn't automatically mean something is expensive.
Absolutely critical point. The market might be pricing in very real, very significant risks. That steep equity skew. It often reflects genuine fear and uncertainty about potential drops. Just because IV is high doesn't mean it's too high relative to the market's perception of risk.
So analyzing the skew is a tool for understanding, not a magic bullet for finding mispricings.
Exactly. It tells you what the market is pricing, but not necessarily whether the market is right. It's a crucial piece of the puzzle, but not the whole puzzle.
Which naturally leads us to acknowledging the limitations. Even with all the sophisticated analysis of smiles and skews, predicting and trading volatility is still hard.
Oh, incredibly hard. For starters, volatility itself is volatile. It changes, sometimes dramatically and without warning. Forecasting it accurately is a huge challenge. Historical vol is backward-looking, implied vol is forward-looking based on current expectations, but those expectations can evaporate or reverse overnight.
And even the fancy models we mentioned, like the ABR or Heston, while they try to capture volatility dynamics, they still rely on simplifying assumptions, don't they?
They do. They're far better than basic black skulls at fitting the smile and thinking about vol changes, but they're still models, not perfect replicas of reality. The fact that they're discussed in advanced courses in our areas of ongoing research tells you there's still complexity and nuance involved.
And a key limitation. Volatility tells you about the potential size of moves, but not the direction.
Exactly. High-fi means the market expects big swings, but doesn't tell you if they'll be up or down. You need a directional view as well, usually.
And our sources mentioned briefly that smile skew analysis is just one tool among others for looking at volatility.
Yes, it's part of a bigger toolkit. Traders also watch broad market volatility gauges like the VIX index. They might use statistical models like JRCH to forecast volatility, or even simpler technical indicators like average true range, ATR. Each gives a different perspective. Understanding the smile and skew provides that deep dive into the relative pricing of options across strikes and time, which is unique.
Okay, so let's try and wrap this up. We've really journeyed through this complex landscape. It seems clear that the volatility, smile, and skew are way more than just academic ideas.
Absolutely. They are the direct, observable result of real market forces, supply and demand, hedging behavior, collective fear and greed, all layered on top of the fact that simple models don't fully capture real-world price distributions.
They tell us the market doesn't see all potential future outcomes as equally likely, especially when it comes to the big moves, the tail events.
Right. That persistent negative equity skew is a constant reminder of the market's structural demand for downside protection. And the different shapes in FX or commodities reflect their own unique risk characteristics.
And crucially, these shapes aren't set in stone. They breathe, they shift, they react to news, to changing sentiment across all the different strikes and expirations. Understanding this dynamic is vital.
It really is. For valuing options correctly, for truly understanding your risk exposure via those adjusted Greeks, for managing that risk effectively, and for crafting trading strategies that are actually informed by what the market is signaling through the volatility surface.
You could almost say the volatility smile and skew show us the price the market puts on fear, the cost of downside insurance in equities, and sometimes on greed, the premium for upside potential in commodities. It's pricing those fat tails and the asymmetry we see in the real world.
That's a very good summary. It's the market's quantitative expression of its risk perceptions, mapped across different potential outcomes.
Which leaves us with a really interesting final thought, doesn't it? How much are these shapes, these smiles and skews, truly predicting future volatility? Or are they, to some extent, a self-fulfilling prophecy driven by the very hedging and speculative activities they reflect?
That's the multi-million-dollar question, isn't it? Is the skew high because the risk is high? Or is the risk high partly because the skew encourages certain hedging flows that can exacerbate moves? It's likely a feedback loop.
A complex dance between market expectations, model limitations, risk management needs, and actual unfolding events, all priced into that volatility curve you see every day.
A fascinating dance indeed.